Hello students, I am your MB ma'am. I was taking your tax class before this pandemic started, before this closure started. So we are worried that we could not make any progress in your syllabus. In the past section, although I took a few classes, in the honors section I could not take any. So I'm really worried. I hope you people are studying on your own. Today I have decided to discuss a little bit on profits and gains of business or profession chapter, which I don't think is very difficult and you can handle it with a little bit of guidance. So I'm just going to give you a guideline, a structure as to how to calculate the profits and gains of business or profession. And mind you, this is for both honors and pass sections because the syllabus is same and the method of calculation as per the income tax rules are also same. So I'm going to discuss. Business as such is a common concept of business which we are familiar with. That applies here also. And profession is a kind of a vocation which requires a specific skill and specific knowledge and which requires to be registered and so on. So the common concepts of business and profession applies here. I'm not going into the details of the definitions. Now you may wonder, why should we learn separately the computation of profits of business? Because we know how to prepare profit and loss account. So profit and loss account itself gives the measure of profit on which definitely one can pay tax. So this is very simple, but no. Income tax rules are sometimes different from the accounting rules. It's not that the accounting profit that we have calculated is wrong. From accounting perspective, it is right. But when you are going to pay taxes at the end of the year, income tax authorities have certain rules which need to be complied with. So, to comply with the income tax rules, we need to adjust our accounting profit. So, we need to adjustment in the profit figure of the profit and loss account or loss figure, whatever it may be. We need certain adjustments. So, in this chapter, we have to learn what are the adjustments that we are supposed to make the accounting profit, to convert the accounting profit into taxable profit. So that's our task. I repeat once more, for conversion of accounting profit into taxable profit. That's what we have to do. Now, applying our common sense, we can make a little bit of, quite a good amount of progress in this, in the solution of this problem. So the starting point will be accounting profit. That is, you have prepared a profit and loss account, you are given a profit and loss account, you got the profit figure. Let us start with that profit figure. That needs to be adjusted in compliance with the income tax rules. Now the thing is that income tax authority usually allows all expenses of the profit and loss account which are directly in connection with the business, which are either very closely or remotely related with the business. Those are all allowable, meaning they are allowed to be seated in the debit of the profit and loss account, right? So some expenses which are related to the business and which are incurred during the previous year are all allowed. I'll forward a PDF in which the entire structure of the calculation is given, but let me discuss following that structure itself. Okay, so we are starting with the net profit as per profit and loss account. Okay, then we will consider the, certain expenses, the expenses which are posted to the debit of the PL account, whether they are allowed or not, whether they are logically connected with the business or approved by the income tax authorities or not. First of all, let us take certain personal expenses of the proprietor. Say life insurance premium paid. Life insurance premium is a personal expense, right? So it is not connected with the business. So it needs to be taken off the PL account as per Income Tax Act's rule, right? So if we take any expense of the profit and loss account, what will happen with the profit? Profit figure will go up, right? Profit will increase if we take away any amount of, if we withdraw any amount of debit amount from the profit and loss account. So all personal expenses are disallowed by income tax authorities. So all personal expenses like life insurance premium or domestic expenses, whatever. So if you judge it is by your applying your common sense, if you find the some expenses are personal expenses, just straightway take them off from PL account, meaning the impact is add it to the profit and loss account or add it to the profit figure. So we will make a broad heading, expenses disallowed. First of all, there will be personal expenses. All expenses which are of personal nature will be disallowed, meaning they will be added back. Next comes the provision for bad debt. Bad debt is a genuine expense. Provided it is actually bad debt, there is no doubt about it, right? But provisions are not actually expenses. They are simply setting aside a part of the profit in case any contingency happens, in case any emergency appears. This provision, this part of the profit will be used up. So provision is not a real expense. It's not an actual expense. So it is disallowed. So it will be added to the profit. Next, bad debt written off. Bad debt is an expense. Bad debt written off should be treated separately. I should be coming to this point later. Before that, say income tax paid. Income tax is a personal expense, so it should not be appearing in the business profit and loss account. So it will be taken off from the PL account, meaning the profit will increase. So add income tax amount paid. Loss on sale of asset. So in profit and loss account, we debit the loss on sale of assets. There is no mistake about it. But income tax authority says that for treating loss on sale of asset, there is a separate head called capital gains. All assets and liabilities, all assets are treated, or sale of the assets are treated in the capital gains chapter. So it will be taken off from here, meaning the profit will increase, and it will be treated in the capital gains chapter. Proprietor's salary. Proprietor is supposed to get only profit. No other expenses will be debited in respect of him. So proprietor's salary is a notional expense, meaning it is not actually paid by anybody, right? The proprietor is paying to himself. So whatever is paid to himself is not treated as any expense. So it will be taken off. So it will be added to the profit. So we are just continuing with the expenses disallowed, right? Along the debit side of the profit and loss account, we are scanning the items and we are finding out which are actually not allowed, which are of personal nature or which are of notional nature, or they belong to other heads of income. They are all taken off from PL account and they are added to the calculated net profit. Next, donations. Donation, sometimes we wonder the business is donating something to, like presently we all are donating to the best possible way. We are contributing to emergency relief fund of the state government and the central governments. So these donations, if the business houses also are making donations, so will it be treated as a business expense? No. Income tax authority says that for donation there is a separate section called 80G. Perhaps you have not yet started that chapter. Later we can come to that part. So for donation there is a separate chapter, separate section. So donation is not essentially a business expense. It is not incidental for running the business. So it is a disallowed expense. So it will be added to the profit. Next, any kind of capital expenditure, unless it is a scientific research expenditure, all capital expenditures which if by mistake they are debited to the profit and loss account, they all will be taken off and it will be added to the profit. Some legal expenses are only allowed to be posted. Any expense which are of illegal nature, for fines and penalties paid for violation of any rules and regulations and customs duties and so on. So they all are not essential for running the business. So those expenses which are of illegal nature, which are for ratifying some undue activities, they are all disallowed by the income tax authorities. So the profit will go up. The moment we are taking off any amount from the profit and loss account, profit figure is going up. So this way, all expenses will be just judging. Okay, we'll be asking ourselves, is it allowed? Should it be allowed? No. Then add it to the profit. Okay. There are certain expenses which need to be read separately in details, but I will come to those points later, but I'll just give you some ideas about the normal expenses. Okay, not the specific ones. I will come to those points later. Expenditure in excess of rupees 10,000. If it happens that a business is spending certain amount of money for buying or for making any kind of payment for services, which amount is more than 10,000 and the amount is being paid in cash. In that situation, the entire amount is disallowed, meaning it's taken off from the PL account and the profit figure increases. The rule is that if you make any payment in excess of 10,000 by cash or without a check in that situation, not the excess. Suppose you are paying 12,000. So you may wonder that, okay, 2,000 will be disallowed, 10,000 will be allowed to be posted to the debit or the PL account. But no, income tax rule says that entire 12,000 will be a disallowed expense if it is not paid by check. Similarly, there can be certain unexplained expenditure. Suddenly, in your bank account or through your cash book, you found that there are certain expenses which could not be explained. What are the heads of expenses you could not explain? In that situation, the entire expenses are disallowed. Okay, so for unexplained expenditure, undisclosed expenditures which are suddenly unearthed, which are suddenly discovered, and for which you cannot give any proper explanation as to for what purpose it has been spent, so the entire amount will be disallowed, meaning profit will go up to the extent of unexplained expenditure. So this way you can judge yourself, you can ask yourself and make a list of add. Then less disallowed incomes. Come to the credit side of the profit and loss account. There are certain incomes as per accounting rules, like sale of assets, right? Sale of assets means when you are selling up any furniture or the computer or anything, you are making a profit out of that. Fine, there is no problem in accounting, but income tax rule says that for dealing with this, there is a separate head called capital gains. So whenever you are selling any asset, you are making any profit out of that, it will be treated in the capital gains chapter, not in the business profession. So it will be taken off. So when you take off any item from the credit side of the PL account, obviously your profit figure is coming down, profit figure decreases, so less incomes disallowed. Similarly, dividend received. You are getting a dividend. Fine. Accounting rule says that when you get a dividend, it is credited. But no, income tax rule says that for treating dividend, there is a separate head called income from other sources. So in that head, the dividend will be treated, but it will be not coming in the profit and loss account of the business. So if you take that amount off, the grand total comes down and the profit figure comes down. Okay. Similarly, refund of income tax. Income tax is a personal expense, and income tax refund you are getting when you are getting, suppose you have paid excess income tax, now you are getting it back. Income tax authority, after their calculations and all this, they are giving you back your excess amount, they are refunding. So this refund, when the business gets, it is not an income as such. Okay, so you are getting just return, not the, it's not an earning as such. So if it is debited to the if it is credited to the profit and loss account, it has to be taken off. You remove it from the profit and loss account, obviously your profit figure will fall. Rent from a house property owned by the proprietor himself. So no incomes and no expenses which are of notional nature. Notional nature means which are not actually real. You are making a kind of a proprietor himself is suppose involved. So he is running the business in his own property. So the rent he is paying to himself, or house property that he has given to the business. So business is giving rent to the proprietor. So that rent is the owner's personal income, and it is not a business income. Okay, and gift received from others, there is a separate rule for the gifts, that to that point I will come later, but just mind you, all expenses and all incomes which are not essentially treated with the business will be removed from the profit and loss account to calculate the profit and taxable profit. And similarly, when there is undervaluation or the overvaluation of the stock, that needs to be adjusted. Like when the closing stock is undervalued, meaning it is valued at less than 100%. Suppose it is valued at 90%. So you have to increase it. You have to make a valuation at 100%. So increased it to 100%. So when the closing stock increases, the gross profit increases as a balancing figure, and the net profit also increases. Okay. Similarly, when the closing stock is overvalued, meaning it was valued at 110%, you have to reduce it to 100%. So when you are eliminating 10%, your gross profit also falls to the extent of that 10%, and net profit also false. So this way you have to make adjustment for the opening stock as well. Now in this point there is depreciation plays a vital role. For depreciation I will have a separate lecture. Depreciation figure as computed by the accounting rules is absolutely different from the income tax rules. The income tax authority income tax rules provide a separate method of calculation of depreciation. So depreciation figures as per the accounting rule and as per the income tax provisions will always differ. So that's why what we do in accounting depreciation, meaning depreciation as is given in the problem, is always disallowed, and later whatever is allowed by the income tax rules, that is allowed. So first accounting depreciation is disallowed and depreciation as per income tax authority's prescription is allowed. This way we make a separate treatment. So in a nutshell, to sum up the method of calculation, what we can say that start with the net profit as per profit and loss account, add all expenses which are not allowed, meaning which are not directly connected with the business, which are not incidental to the business, and which are of very capital nature and which are of personal nature. All those expenses will be taken off from PL account, and that's why the profit figure will increase. Similarly, all incomes which are of not related to the business, they belong to different other heads like capital gains or income from other sources or something like that. So all those will be removed from the profit and loss account, meaning profit figure will decrease. And at the same time, depreciation should be treated separately. Once accounting depreciation should be disallowed and income tax provisions depreciation will be allowed, and adjustment for the income tax opening stock and closing stocks are to be done accordingly. This way, after adjustment, we will get the profit figure or accounting taxable business profit figure. Now this is the basic structure. There are certain heads which need to be discussed elaborately, like scientific expenditure on scientific research, depreciation, and certain other heads like preliminary expenses. These few items are there. I will come to those points in a separate lecture. So with this, I am forwarding to you a PDF, so giving a detailed breakup of how to calculate this thing. And similarly for the profession also, just let me tell you, for the professional incomes, professional profits and gains, what do you have to do? You just have to make a statement of incomes, all incomes which are incidental to the profession, like for a chartered accountant, fees from the client, consultation fees, income from accounting work, fees received from conducting IT, income tax appeals, etc. These are the basic nature of the incomes for a cost account or chartered accountant. So all these incomes will be taken together, less all expenses incidental to this earning, like his books and journals purchased, his assistant salary, and certain other transport expenses, etc., office maintenance expenses. Those expenses will be subtracted, and finally we will get the profit figure. In this situation, there are certain expenses which are of composite nature, like say chartered accountant runs his profession from the first floor of his building. So the expenses in connection with the electricity comes in a single bill. So you have to make a segregation between the professional expense and personal expense. Like the motor car he is using both for his personal use and for the professional use. So you have to make a segregation between, the percentage will definitely be given to you. You have to make a segregation between your personal expense and professional expense. So this is simple. You take the incomes related to the business, related to the profession, whatever it is, like a medical professional or chartered accountant or a lawyer or any kind of consultants who are running in a profession. So the all incomes are taken absolutely related to the profession, less all expenses which are absolutely related to the profession. This way we get the taxable professional income. So with this I end today. You follow my PDF and try to solve the problems. In case you find any problem, you can mail me. In the PDF I will give you my mail ID. There you can mail me, you can send your queries and so on. So hope you are keeping well. Stay home, stay safe, don't move out, take care. Bye.